Good morning and welcome back to Almus Market Mornings. It looks like Scott Bessent isn't done with the bond market just yet, and after the yields climbed to multi-year highs, he signaled that the administration has a bigger toolkit ready, with longer dated bond buybacks set to increase by at least double and potentially go beyond the 4 billion currently planned. And clearly, we can see that there's a growing concern around the borrowing costs and how high yields could impact the broader economy. And on the AI front, we have Anthropic joining the club this time of IPOs, as they are now reportedly looking to match or even beat SpaceX's record setting IPO after raising $65 billion at a valuation of around 965 billion earlier this year. Good morning, JK. Are we seeing the start of a much bigger push from the US Treasury to bring the bond yields under control? And what do you think this means for the market?
Good morning, Eshan. So I think now the market is looking at twin failures by Scott Bessent because we all know that a couple of weeks back he intervened, rather U.S. Treasury intervened along with the Bank Japan to stem the USD yen rise, and after having seen 155. The dollar yen is back near 160 now. This is despite the correction that we saw in the bond yields a day before. So the Bank of Japan is of course not doing its bit by raising rate, which is the need of the hour because the US Japanese yields are deeply in negative territory, and then the market yields in Japan are going up to new highs as the fiscal worries continue. If yen does not listen to the moves by Bank of Japan and US Treasury, that definitely is seen by the market as a failure. And if it breaks 160, we could well be headed to the previous high. And the other failure is other possible failure, of course, is that the US yields inched back up again yesterday to regain part of the losses for the previous day, particularly in the long end. And of course, part of this was also due to the rise in prices of oil as Iran embargo continued. At the same time, bond vigilantes have not changed their negative view on the critical position of the US on its fiscal and unmanageable debt position. Traders have a feeling that Treasury's surprise move might only show that it is getting more creative in addressing the growing borrowing costs rather than doing something about reducing the debt, which is the most critical thing, the debt in the fiscal position. So this would mean going forward, authorities will have to adopt more drastic policies to ensure the stability of the bond market. Meanwhile, the diversification, of investors from USD into other major currencies and gold has continued. That is the immediate fallout of this, apart from raising the prospect of further rise in the yields, as the move has been very, very minimal in terms of what the market is looking at. Now, evidence that U.S. administration is, getting more and more concerned is seen from Bessent's statement that he said that the buyback could be more than 4 billion. And he also said it's a part of the signaling that Treasury is giving to the bond market. And we want to show that yields do not reflect the underlying fundamentals. But no one will believe, because fundamentals do demand that yields should be higher. One, the inflation has been above target for now 5 years. And then the borrowing from the US Treasury is not seeing enough appetite in the market. Because the fiscal position and the debt situation, the debt which has crossed 40 trillion now, is demanding a higher term premium by the market. Now, he also said, the US, there is a very good chance that we have seen the peak in the deficit. Again, it's very difficult to convince the market because we are seeing interest costs rising to record highs, and we have the huge military spending, and nowhere there is an effort to cut down the spending by the US government. and the growth is not sufficient enough to make up for these, spending a higher deficit as well. Now, the biggest statement which the market would be perhaps gleaming at is the US dollar. He continued to have a strong dollar policy, and that is definitely sounding a bit hollow because when they are, not able to, when they're focusing on the bond yields, and to protect the market by printing more money in a way, it is the dollar that is going to weaken, and it's very difficult to see how the dollar in a broad sense would be gaining in these circumstances. That's the situation as far as the bond market is concerned. I think, to answer your question, I think we are going to see much more turbulence in the bond market, and the action that is needed by the US administration should be far higher, far more stronger, and to convince the market that they are in control. It could be a long journey because we know that in Japan also, when the yield started rising, they resorted to yield control, and that has continued for a very long time. And the ballooning of the Japanese central bank's balance sheet is an evidence of this. So bond market continues to see higher yields in the coming days, and then that puts a lot of stress. And the IPO, which you mentioned about Anthropic, that actually takes away more liquidity from the market, and investors could probably see more profit in investing into these IT companies' shares, at least in the IPO, than in a bond market where the yields are rising. In other words, the asset that you buy today will not be of same value tomorrow. So that is the situation. And in the economic data side, we had jobless claims fell yesterday, and the fully fed manufacturing surged to highest level in 5 years. So one part of the economy, that is the manufacturing, is been doing well, but that is not enough to convince the stock market. Yesterday, all the three indices, the Dow Jones, Nasdaq, and the S&P 500, lost. And the borrowing costs are rising. They are, not able to hold on to the highs. And one more factor for the stock market was the disappointment from earnings of the retail giants like Walmart. So again, it's a more great, bigger evidence or additional evidence that the consumption is faltering, and consumption is the backbone of the US economic growth. We already seen retail sales data last week, which was weaker, and then the consumer sentiment also falling. So markets are concluding correctly that if the Treasury does not want bond market to take the strain from these concerns about fiscal policy, sustainability, and Fed policy credibility, then the dollar will have to. So the dollar. Okay, coming to the dollar, Ishan, I see more weakness coming in the you know days ahead, because the US government, if they want to protect the bond market and to ensure stability of the stock market, they will have to give up on the dollar. And, as they print more money through some way or the other, either whatever the bond purchases or QE, whatever they do in the coming days, which will be a necessity, we can see the major currencies like Euro and GBP gaining. Commodity currencies will also gain because the debasement trade of selling dollar and getting into the hard assets like gold, silver, and other metals, and is also going. In fact, the evidence is also seen from the Bitcoin, which has made a large gain in the last few days, well above 15% gain that we have seen in the last few days. So clear evidence that dollar is weakening against major currencies and select EM currencies as well. But then when I speak of the dollar, the striking feature of our own market was that everything moving, but the rupee not budging. The dollar rupee did open with a slight gap down around 55, 95, 55 levels, but steadily moved up towards the previous day's high at 95.70. And, that's also led by consistent buying that we've seen at the lows. And even the PSU banks were part of it. market reports that buying was related to some debt repayment as well. In any case, the sellers are not very keen, and FI flows was mildly negative also. So we are not getting the sort of support for the rupee from the major market move elsewhere, because rupee is being seen in a different light. And the oil price rising once again towards 93 is also not helping much. There is, of course, RBI's intervention, which is very mild in my view, because the market is steadily buying into the dollar, particularly the importers and as well as the PSU bank. So another point is that whatever the US government is doing on the bond market is helping the major currencies, and the diversification is not going to help the rupee because rupee has its own structural issues. So and oil price keeps going up, rises the deficit in India as well. So these factors keep the rupee on the weaker footing. Yes, it may not break too much on the weaker side, but I think 95, 96 range should hold with slight dominance of the importers. Definitely, if we do move towards 96, I expect aggressive intervention by RBI, particularly now that they have a good amount of dollar liquidity. So we are ending the week with on a sober note, kind of dollar on the weaker side broadly, and of course risk assets are now facing more risks. Thank you.
Thank you, Jayaram. So, and just to summarize, the first to note is that the Bank of Japan is not doing their part with the economy by raising the rates, as we can see market failure by the yen as it's almost close to 160 after we saw the intervention of 155 levels. The second point is that it looks like the bond yields again inched up yesterday, so concluding that the authorities will have to adopt more drastic measures to contain the situation, which has resulted to Scott Bessent talking on the situation again to increase the long-term buybacks of these bonds beyond 4 billion as well. And we're going to see more measures on this too, keeping the yield situation in place as these continuing higher yields in this situation. And the Anthropic AI is also only doing its part by sucking the liquidity out of the markets, as I mentioned before. And coming to the dollar, it is holding the weak levels against the major currencies to keep the bond market stable, and also the stock market. Looks like the US have to give up on the dollar, and evidence is also seen about this from the Bitcoin, which has had a huge spike in the last few days. And domestically, USDINR is not showing any appreciation even in a time of dollar weakness, as the pair instead moved higher yesterday after opening, and buying was seen, and it is being seen in more of a different light, as we also have oil prices increasing and being at its 1 month high yesterday, which is not helping the markets. So we look to see the range of 95, 96 hold for now at least. Thank you all so much for listening. I will catch up on Monday with a fresh round of updates. Thank you.